Hello everyone, welcome to PwC Tax Bite podcast series. I'm of course still Pieter, and I welcome you to this fourth episode of our special CBAM sub-series. As you know, we have a number of episodes here where we talk about CBAM. In the first episode of this sub-series, we talked about the broader policy scene of CBAM, and we looked how this links with the European carbon taxation landscape. We had another episode 2, where we went under the hood of CBAM, the cost calculation. We looked at why CBAM is a real financial and governance issue for companies. The third episode, we went on the corporate strategy. So the pricing, the impact. Are you able to cross-charge the price increase to your customers, and how does it work? And logically, we now come to the fourth episode where we're going to talk about what happens with the CBAM cost within a group, and then we talk about transfer pricing. So I'm very happy that I can welcome, of course, Helena again to the podcast, or expert in the field, but also Joris Reijnierse. Joris is a transfer pricing expert, but also with many years of in-house, we call it, experience. So the perfect person to combine, let's say, transfer pricing with the practical aspects of CBAM and how to deal with that within the group. So welcome back, Helena, and welcome, Joris.
Thanks, good to be back.
Thanks, Pieter. Thanks for having me. This is an interesting topic. Look forward to our conversation.
Exactly. Wonderful. Well, let's dive into it and the topic. So in episode 2, we talked about the mechanics of the CBAM cost. So how does the emissions embed the certificate price, the CBAM factor to volumes, potential deduction for carbon prices paid outside of the European Union. So without rerunning the entire calculation, Helena, can you remind us why this matters so much for transfer pricing?
Yeah, so the key point is that CBAM, it creates a cost with a very specific profile. So it arises because goods cross into the EU, but the amount of the cost depends on much more than just the customs entry itself. So it depends on the carbon intensity of the production process, the quality of supplier emission data, whether default values are used, the EU ETS linked certificate price, and whether a carbon price has already been effectively paid in the country of origin. And that makes CBAM different from many traditional import costs. It is not just a fixed tariff percentage that you can easily model once and forget about it. It's dynamic, product-specific, supplier-specific, and also increasingly linked to strategic decisions around sourcing and decarbonization.
Okay, thanks, Helena. So this customs obligation may very well sit with the European importer, but the economic drivers may then sit elsewhere in the group, right?
Exactly. And so the authorized CBAM declarant may be the EU importing entity, should be an EU importing entity, but the levers that drive the costs, they may be controlled by procurement, manufacturing, sustainability, or a regional or a global principle. And that distinction is what makes the transfer pricing analysis so important.
Okay, well, that brings us then to transfer pricing. So Joris, from your perspective, with your experience, how should multinationals be thinking about CBAM costs from a transfer pricing perspective?
Well, thanks, Pieter. Yeah, many companies think that actually CBAM is just another cost in the value chain. But the question, of course, is how you need to deal with those costs and where those costs should land in view of the existing eco-structure of the respective group as a whole. So if you think about it, the traditional value chain analysis, carbon cost is not just another input cost like raw materials or logistics. It is a regulatory cost that arises specifically because goods are crossing borders, and you need to understand what it actually does in your overall value chain. Some groups treat those costs as pass-through costs without really analyzing who in the value chain actually bears the associated risks or controls the decision around these type of costs. And the question, of course, is how would you treat those costs at arm's length? And if you think about it, conceptually speaking, as the CBAM cost, if you just treat them as ordinary costs and you put it in the system, it won't help you per se. You really need to understand your functional profile and who is getting the cost in first instance, who is actually managing and controlling those costs, and well, can you push those costs towards your customers? And if that's not the case, yeah, then those costs flow back into the value chain, and then the question is, yeah, who should pick up the overall cost? So those elements, if you think about it, there is a consistent knock-on effect across the entire value chain and transfer pricing model that you need to consider when you actually are confronted with these costs. And well, we see more and more often companies strategizing how to deal with that.
Okay, thanks. So yeah, looking at functions, what you said about limited risks and so on, who should bear the costs? Maybe let's dive a little bit deeper. What does this actually mean, Joris, for how groups have to set their intercompany prices?
Well, good point. So the primary question is, what do you do at arm's length? What would unrelated parties do? And well, unrelated parties, of course, would try to renegotiate the current pricing mechanisms if incremental costs are put on the table. And typically, carbon exposure, those related costs, would be included in the pricing mechanism. At the same hand, transfer pricing agreements, intercompany agreements need to adhere to the same logic. So the bargaining power between parties actually would bring a result that should reflect at arm's length positions. Now, if you think about it, as an example, a group produces aluminium or steel outside the EU and sells it into the EU via an intercompany distribution arrangement. So then the question is, if you have an intercompany pricing arrangement based on a cost plus method, then the manufacturing unit would have to include those costs into the value chain. Now you have new meaningful costs, CBAM certificates. What do you do with those costs? Would the manufacturer outside the EU absorb those costs, or would you want to push those costs towards the distributor, or does it get shared? Now, depending on your operating model, the principle, so you will, in this particular transaction, should be the one driving those costs and appreciating those costs. So if the principal entities controls procurement, production decisions, the carbon strategy, you could argue that those costs should in the end up with the principal entity. But that's not per se a given, because you could also argue if the EU distributor is the importer of record and actually is contractually obligated to purchase those certificates, you could also decide or strategize whether you could increase the remuneration level a bit for the distribution entity to actually absorb those costs. Now, if you have a routine distributor that already earns a very limited cost or margin, then you can question yourself whether an incremental cost should be further absorbed by that distribution entity. On the contrary, those costs should then not be absorbed by the distribution entity, but rather with the principal.
Okay, so you wonder what would a third party basically do, and you try to allocate the costs to the right entity. Very interesting, very interesting. Now, I'm just wondering what kind of information can, from a transfer pricing perspective, can you take into account to make that analysis? Helena, what kind of information, what facts should the tax people in the podcast here ask for to do that exercise? What's available?
Yeah, I think it's very important to understand that not each CBAM product is the same. So you have a lot of different cost drivers. So which products are in scope, and one product within your product portfolio it can look like the same product, but actually have a different supplier or a different production installation. So the embedded emissions can be totally different. So embedded emissions is an important question to raise and information to share with the TP team. The actual verified emissions available, or are there default values being used for the specific product that you're looking at? Also, is there a carbon price already paid in the country of origin that may reduce the CBAM obligation? And then, who in the group has the ability to influence those variables? And that last point is critical. So even EU distributor, as I understand it from Joris, simply receives goods and acts as importer of record, but the non-EU principal chooses the supplier, controls the production footprint, negotiates the supply contracts, decides whether to invest in lower carbon inputs, then the distributor may have the legal filing obligation, but not at all the economic control over the cost that they are paying, and the cost for which they are needing to buy the CBAM certificates for. Do I understand correctly, Joris?
Yeah, absolutely. Yeah. So in the example that you gave, the cost associated with with obtaining those certificates that are actually incurred by the distribution entity will, via the transfer pricing mechanism, actually be transferred outside the EU in your example, as we assume that the entity outside the EU is indeed managing and controlling and overseeing the overall value chain and makes it the strategic decisions to actually, sell into Europe, given its production capabilities outside Europe. Now, if you think about it, you said it already, the fact that the company who causes or influences the cost, that's an important aspect to appreciate. Then, who is contractually responsible for those costs? And then, third, who has the financial capability or capacity and the decision-making control to bear the actual cost or risks? And if the answer to those three questions actually point to different entities, then you need to really consider your transfer pricing policy, because it needs to be consistent. The assumption that your entity is appreciating the cost in first instance doesn't say it actually should bear those costs. On the contrary, the company that actually is managing and controlling and overseeing those costs effectively should realize those costs in its P&L as well.
Okay, that's very insightful. So clearly, a case-by-case analysis is required, Joris. That's very clear, and you also made it very clear that it's not always the importer or the principal that has to bear the cost. So it really depends on the fact pattern at hand. In TP, Joris, a lot is said about often benchmarking, comparing with other entities to define what is an arm's length pricing. We already discussed in the previous episode that CBAM is now also a P&L and cash issue for many companies. How does that interact with benchmarking and comparability, Joris?
Yeah, that's a very interesting question. If you look at benchmarks per se, there's always a time lag in what is included in those benchmarks. So the cost that you incur today are probably not already reflected in the comparables that we have, because comparables always look back a couple of years. So there is a time lag in your comparability data versus your actual cost. So when you strategize your benchmarks and how to set the remuneration level for the various entities involved, it could well be that you need to make comparability adjustments to your margins, to your benchmarks. And if you do so, then you need to obviously document it very well, because the choices that you make now to appreciate certain costs in the P&L of a manufacturing unit or a principal, that will be a relevant parameter when you have your benchmarks later on in case of tax audit. Now, if you think about it, if you include a margin in the distribution result per se, because the distributor is the importer of record and has included its cost in the P&L, and you do need to make a year-end adjustment because of that, then it's very important to articulate that you indeed do make a year-end adjustments, but it actually is the result of an incremental CBAM cost. And then the question, of course, is, you report that at the principal, which does make sense at that moment in time.
Okay, Helena, from where you look at it, do you recognize this? What Joris is saying, this challenge?
Yeah, and well, I think two things. So as I said before, the underlying data of CBAM, it can be quite granular. So within a company product portfolio, it can look like two products with the same commercial description, that they would have the same CBAM profile, but in fact that can totally be not the case, because they come from different installations, they use different production technologies, they come from other suppliers, or they rely on default rather than on actual emissions data. So my worry has always been, and also when we are advising clients, make sure that you share enough of that information and of that data, because one CBAM product is not the same as the other CBAM product. And also what I take away from what Joris has already been explaining and where we're getting here, I think it's very important that CBAM becomes that boardroom topic. So to make sure that enough information, data is shared widespread over the company, so that decisions can be made where they need to be decided.
Yeah, thanks, Helena. A thought that I had, Joris, when you were explaining the different TP methods, the benchmarking and so on, when that homework is done, when as a company you have decided where the cost of CBAM should be taken into account, I guess there's also then an important reminder or link to the intercompany agreements that are in place, right?
This is one of the traditional interesting topics, Pieter, because many companies have intercompany agreements, if they have them, and then it's quite a static document. But the reality is that actually the intercompany agreement should obviously align with business realities. And if you have incremental costs like CBAM in your value chain, the question should be there. Hey, is my intercompany agreement actually appropriately accommodating the incremental cost? What does my intercompany agreement say on how to treat those costs? And if nothing is said, and you will have questions from the authorities, and you have an old, between brackets, intercompany agreements, but actually you have added certain costs in your value chain that have not been accommodated in your agreement, then it's a missed opportunity, and you will have difficulty to defend the positions that you actually take. So the fact that you now have a new setting with the CBAM cost as a new reality is also an opportunity to revisit your existing intercompany agreements and ask yourself the question whether that's actually appropriately reflected or enough leeway, so you will, in the existing agreement. And the funny thing is, also with the whole customs and trade debate out there, the prerequisite for TP teams to further interact with customs and trade colleagues is crucial. And I understand from the previous episodes that it will be important to understand the narrative that you put in your intercompany agreements and how you deal with that from a customs perspective. Because if you're non-aligned, then it creates inconsistencies, and then you have probably commercial and tax risk correspondingly.
Yeah, thanks, Joris. Makes absolutely sense, of course. Let's take the benefit of having you here to broaden a little bit our discussion again, because in one of the previous episodes we talked about the free allowances under the European emission trading system and more broadly the Green Deal. I guess there is also a link there, with transfer pricing. So I'm interested to explore that a little bit. Helena, maybe can you recap a bit what the key point here is?
Yeah, indeed. Yeah. So CBAM never comes alone. It's part of a wider shift in how carbon costs are affecting business models today. So you have EU-based manufacturers in CBAM sectors. They are seeing the gradual reduction of the free ETS allowances, while importers of the CBAM product they are facing the CBAM on the comparable goods. Now, at the same time, companies are rethinking sourcing, customer pricing, and also their decarbonization narrative. And those commercial responses, they can change where functions and risks sit in the group.
Yeah, thanks.
This is triggering a lot of size issues. So I'm not saying that companies are restructuring per se because of the new emission trading system. At the same hand, the companies are reorganizing their supply chains, and in response to the Green Deal, and with the relocation of production or changing sourcing plans, or organizing their people functions differently. And if that is the case, as a side effect of the strategic initiative linked to the Green Deal implications, then the traditional transfer pricing topics associated with business restructurings need to be evaluated. And the funny thing is, these type of conversations are in first instance not triggered by tax people. On the contrary, the business is changing, but how to make sure as a company that you don't miss out on the interactions between the various departments. Because if you do something from a strategic perspective and to accommodate the emission trading system that's phasing out, and you reorganize your supply chain, do you then indeed involve your tax colleagues at the right moment, at the right time, to make sure that, if there is any exit charges or new transfer pricing arrangements or operating model consistency type of arguments need to be evaluated. How do you do that at that moment in time? Now, that's an important topic to understand your value chain considerations. Then the question, of course, is carbon allowances and carbon credits. How do you actually price those intercompany? Well, I think what we said before, there is an emerging market for carbon credits. So there is some data available, but the question is always how to value those credits. And the best thing to do is to look out there what is in the market and the market value, but it's not an easy answer to give there. Then third, and that's a really complex topic, the disclosure topic. How do you do that? And the intersection between what you document for transfer pricing and what you document for corporate sustainability reporting. It's quite funny. In reality, many people want to show off a bit how good they are for corporate social responsibility, but they forget to answer the question, is it actually consistent for transfer pricing documentation? And because tax authorities more often do cross-reference checks, and with AI, that's fairly quick and easy to do. That do you tell a consistent story who is actually managing and controlling those costs versus where those costs actually land in the respective P&L. And if you have an inconsistent story there, then it's an easy target to hit on for tax authorities. And so consistency in your storytelling from a company perspective, what do we do for reporting perspective, corporate sustainability reporting, in view of your transfer pricing documentation. Consistency is key.
Okay, interesting point, Joris, about this consistency. Is this a point that also the tax authorities might be looking at, the different sources of information?
Yeah, definitely. We see it more often. And the funny thing is, because groups publish all their sustainability reporting, and if you in that sustainability report say, look, we're investing heavily in the decarbonization of our manufacturing operations, and the report articulates that the central unit and the central EU hub is managing and controlling that on a global level, yeah, then from a transfer pricing perspective, you should be able to articulate that those costs do not land in the local P&Ls. And then that contract manufacturing entities, indeed, are limited risk type of entities with no strategic functions. But if there's a mismatch between the two, authorities will see that fairly easy because in case of audit, to accommodate a cross read between the one document and the other document, that's fairly easy done.
Yeah, and the CBAM reporting in itself also has valuable information. If you report in your corporate sustainability publications that you are decarbonizing, but that your CBAM filing tells a totally different story, because that actually has your carbon emissions in full detail. Companies should pay attention to that. Also from that perspective, make sure that you give the same picture of your company in all those different tax filings.
And that's very interesting comment, Helena. In my time in house, we had the opportunity with the corporate departments to pre-read what they would publish on the web or in the annual report to understand what these guys were publishing indeed does align with what we would like to articulate from a storytelling perspective towards the authorities. So cross-functional collaboration of the transfer pricing team and part of the tax team most often with corporate communications, corporate marketing, corporate supply chain, and the teams responsible for CBAM and what they do report in the sustainability reporting. That's crucial, and it's often overlooked, but it's also very painful if you tell on the one hand this story and on the other hand that story. It should just be aligned.
Mm-hmm.
And more experienced teams indeed take the opportunity and take the assertive approach to be sure that they understand what's on the calendar for publication, and consequently take the initiative to indeed involve themselves if possible, and if appropriate in the organization to make sure that there is a consistent storytelling towards the outside world. And it sounds simple, but many companies work also in silos and do not necessarily know from each other what's actually being published. And typically that comes together at the level of the CFO, who has, the ultimate responsibility for everything that's been reported. So that's also the natural focal point to be sure that the right people are at the table to review the various documents that actually are published out there.
Interesting, Joris. So maybe let me ask you the question: if you would be in this audience, you're a CFO, you're involved in taxes in a company, what would you be recommending the people that listen to this podcast to take as concrete next steps? And maybe Helena, maybe I'll start with you first.
I think two things, and I shared them in the beginning as well, but I think this conversation underlines the importance. First, sharing the data. If you are responsible for CBAM, share the data with your tax colleagues, share it with your transfer pricing colleagues, because they need it to tell that same story towards the other tax authorities. And then second, CBAM, it puts an important cost into your value chain. So make sure that that information is known throughout the company. Make sure that CBAM is a boardroom topic in your company so that the decisions can be taken where they need to be made. I think those are my top two to-dos.
That's great, Helena. I have 5 priorities. First, understand your carbon cost mapping. So where in the value chain do those costs arise? So you really understand, there is a new cost, which entity bears those costs, and how do these costs actually flow through your intercompany pricing? And the funny thing is, although it's a simple question, the reality will be to get a good total view on the overall cost and how that actually is influencing your current transfer pricing. So that's the first one. The second one is, if you have an insight on your total cost, how is it actually influencing your existing transfer pricing policies? Do my intercompany agreements actually accommodate the right outcome when you actually include the incremental cost associated to carbon cost? And probably, or I would be surprised, many companies have not given this much consideration yet. But the question is now, how do you intake or absorb the incremental regulatory cost in view of your limited risk distribution or limited risk manufacturing model that you actually apply also for transfer pricing purposes? And well, have you given it enough thought, properly documented, and well, with the intent to realize the right outcome? So that's on the policy side. And I think the third element that's important to consider is, okay, what's my consistency in terms of documentation? As I mentioned, every company produces a lot of documents every year. Is it not for annual reporting purposes? Is it not for website publication purposes? Is it for transfer pricing documentation purposes? Is there a consistent cross-reviewing mechanism in play, a control, so you will? That someone takes ownership that you are well aligned effectively, and that you are sure a bit that indeed those disclosures are actually consistent. The fourth element, well, it's saying the obvious, but depending on the various industries, you need to understand a bit in what could be the impact if you have adjacent different sectors accommodating your transfer pricing modeling. And what I'm trying to say is that assuming that you have certain costs in your industry, what's the impact if you trickle down those costs towards your customers, and is there an interaction there? And fifth comment, well, engage with your advisors and or tax authorities to proactively disclose your positions in advanced pricing agreements or rulings, and that you can get clarity and assurance on how you want to treat those costs, given your existing transfer pricing mechanism. So instead of waiting for audit, taking an initiative, a proactive approach seems like a better strategy to get clarity and security on certain items. So as a recap, first topic, cost mapping. Second, stress testing against your transfer pricing policies. Third, consistency in your documentation. Fourth, attention to sector-specific dynamics and how does it influence your value chain towards customers. And fifth, take a proactive approach, document properly, and to make sure that you make this topic an actual topic and not an afterthought.
Well, thanks, Joris. That's very concrete advice for the group here. Thanks a lot for that. This brings us to the end of the time we had today to talk about CBAM and transfer pricing. I must say, Helena, I'm very surprised to see how all CBAM is connected basically to all these topics, also to transfer pricing, which we heard today from Joris. Thank you for joining me, Joris and Helena. And the next episode, we're going to touch on the last one in the sub-series here. We're going to talk about accounting and VAT, because there are some interesting links to be shared on that point as well. Thank you, Helena. Thank you, Joris. Thank you to the audience as well for tuning in and for liking the podcast. And we'll speak soon. Thank you.